Raising capital is just a formal way of saying a startup is getting money. It's not about profits yet. It's about getting the fuel needed to build something new. Think of a startup as a small boat setting out to cross an ocean. Capital is the provision of food water supplies. Without it, the boat can't leave the harbor. This money pays for everything in the early days. It pays for the first employees. It pays for the computers they write code on. It pays for the small office. It pays for the coffee that fuels late-night work. It is the lifeblood that allows an idea to become a real thing. Why does a startup need to ask other people for this money? Most big world-changing ideas start with a period where they don't make any money. They are busy building the product. They are finding the first few people who love it. Founders usually don't have enough of their own savings to fund this entire phase. They need outside investment to survive long enough to become profitable. This process of getting money happens in stages. Each stage is like a new level in a video game. Different goals, bigger challenges, new types of people willing to provide funds. This guide will walk you through that journey. We start at the very beginning, an idea on a napkin. The very first stage of funding is often called pre-seed. This is the earliest money a startup gets. It's usually not a lot. The money almost always comes from the founders themselves, using their personal savings. This is called bootstrapping. If they need more, they turn to the 3 F's. The goal of pre-seed funding is simple: to get the idea off the ground. It might pay for building a very basic prototype, called a minimum viable product, or doing customer research to see if anyone actually wants what you're building. After the pre-seed stage comes the seed round. This is where the startup plants the seed that will hopefully grow into a large tree. By now, the founders should have more than just an idea. They should have some early proof that their idea works. A working product, a handful of early users, initial data that looks promising. The investors at this stage are typically angel investors, early-stage venture capital funds. Angel investors are wealthy individuals who invest their own money into startups. They are often former founders themselves and can provide valuable advice and connections. This is often called smart money. The amount of money raised in a seed round is larger than in a pre-seed round. It can range from a few $100,000 to a few $1,000,000. The purpose of this money is to find product market fit. The seed funding provides the resources to hire a small team, refine the product based on user feedback, begin marketing efforts. It's about turning that initial spark of an idea into a small, repeatable fire. Investors at this stage are still betting heavily on the founding team. In exchange for this seed funding, investors receive equity, which means they get a piece of ownership in the company. This is a crucial concept. Once a startup has found product market fit and has a growing base of happy customers, it's ready for the next level, Series A. This is usually the first time a startup raises a significant amount of money from institutional investors known as venture capital firms. A Series A round is all about scaling. Optimize the product, expand the team with key hires, and develop a repeatable strategy for acquiring customers. It is the transition from a small project to a fast-growing company. Following a successful Series A, a company may go on to raise a Series B, Series C, and so on. Each of these rounds is typically larger than the last. A Series B round is focused on expansion, new geographies, new product lines, even acquiring smaller companies. Investors now want a clear leader with a track record of growth and execution. The Series C round and beyond are about pouring fuel on the fire. At this point, the startup is often a well-known company with significant revenue. The goal is to scale aggressively, sometimes preparing for an initial public offering. Throughout these rounds, founders give up equity. While ownership percentage decreases, the value of the remaining stake should rise. To navigate the world of fundraising, you need to speak the language. There are a few key terms that every founder must understand. Equity is the most basic. It is ownership in your company, represented as shares. When you take money from an investor, you give them equity. Valuation is what your company is deemed to be worth. An investor might offer $1 million for 10% of your company, which implies a post-money valuation of $10 million. Two other critical terms are burn rate and runway. If you have $10,000 in monthly revenue and $60,000 in expenses, your net burn rate is $50,000. If you have $1 million in the bank and a burn rate of $50,000 per month, your runway is 20 months. So what do investors actually look for? It boils down to a few things. First and foremost, they invest in people. Second, they look at the market. Is it big? Is it growing? Third, they look for traction. Real evidence that people want what you built and keep using it. The primary tool for communicating your vision to an investor is the pitch deck. This is a short presentation, usually 10 to 15 slides, that tells the story of your company. It should be simple, clear, compelling. A good pitch deck starts by defining the problem. Then introduce your solution. Explain what it is and why it's better than existing alternatives. Cover market size, business model, and your go-to-market strategy. Most important, the team slide. Investors bet on the jockey, not the horse. Then, show traction, user growth, revenue, engagement. Finally, the ask. State how much you're raising and what you'll do with it. Connect money to specific milestones. The pitch meeting brings the story to life. Don't just read slides. Tell a compelling narrative. Start with your personal connection to the problem. Why do you care? Prepare for interruptions and tough questions. Be honest, be confident, be yourself. Goal of first meeting, not a check. Goal, a second meeting. Venture capital gets all the headlines, but it is incredibly rare. The vast majority of businesses are not a fit for the VC model, and that's perfectly fine. Thankfully, there are many other ways to fund a startup. One path is incubators and accelerators. They provide a small amount of seed funding, mentorship, and a network in exchange for a small percentage of equity. Another option is grants, non-dilutive funds from governments, foundations, or corporations. They support scientific research, clean energy, or social impact. Many successful companies are bootstrapped, funded entirely by their own revenue. Companies like MailChimp and GitHub were bootstrapped for years before taking outside funding. Crowdfunding can pre-sell your product to raise capital for the first manufacturing run. Equity crowdfunding platforms like WeFunder democratize investment. Each alternative has pros and cons. The right choice depends on your business, goals, and how much control you want to keep. For investors, the journey isn't over until there's an exit. An exit lets them sell their shares and realize a return. The two most common types of exits are an acquisition and an IPO. In an acquisition, a larger company buys the startup. Famous example, Facebook buys Instagram. Famous example, Google buys YouTube. An IPO is when a private company starts selling shares to the public on an exchange. Real-world examples, Airbnb, Uber. SpaceX has raised huge private rounds to fund its mission. Of course, this journey is filled with risk. Most startups die. Even success brings dilution and potential loss of control. Venture capital is hits-driven. Most investments fail, a few pay for the rest. Trends like AI and climate tech surge, and new funding models connect founders globally. The path from idea to IPO is a marathon, not a sprint. Plan accordingly.